Having a strategy for risk management when you're trading is so important. I'm going to give you the ultimate guide right here. Since I started, I always had a checklist. It was a checklist of a bunch of things that needed to line up before I would execute a trade. And to this day, I still have that checklist that I look at all of the time. I've been doing this for 21 years. Guys, you've been doing this for a year, 2 years, 3 years, 10 years, whatever it is, you need to just have this checklist on your desk. Have it on your iPad, have it printed out, whatever it is, have it on your desk so you don't miss little things that you can protect yourself against. This is where it starts. This is where the mindset of a good trader starts. So the first thing, extremely simple to do. And if you come over to my chart, it is make sure that you don't have earnings coming up. And some of you might be asking, well, why the heck are you looking at earnings? What do earnings have anything to do with trading? Well, let me tell you, earnings are pretty crazy. And I'm going to show you a perfect example. This is Meta. Meta came out, and anything on TradingView, E means earnings. So if it's red, they missed on some stuff. If it's green, they beat. Look at this earnings report that came out for Meta. They came out and they beat their earnings per share by 9%. They beat revenue by just a shade under 1%. And look what the stock price did. The stock price dropped 10.56% that day. It was almost down as much as 20% that day. Now, let me ask you a question. If I were to have came out before they reported earnings and said, all right, this is going to be the report from Meta. Meta's going to come out and they're going to report earnings per share beat, revenue beat, user growth beat, every single thing. And when I say every single thing was a beat from Meta in their entire earnings report. Would you have said that the stock price is going to go up or down? Your answer is up. I know your answer is up because my answer is up. But what happened? It came down. And what happened on the previous report? They beat on top and bottom line. And what happened? They jumped up 20%. It is a completely unpredictable world. Therefore, I don't trade earnings. So when earnings are coming up, I reduce my shares on the position or I exit a position. I know for a fact that Apple has earnings coming up in a couple of days. So if I was trading Apple, I am not right now, but if I was trading Apple, I would be reducing my shares by the afternoon, 4 p.m. of this coming Thursday. This is what you need to do. The number one thing on your checklist needs to be, okay, when are earnings? So if I'm looking at something like Apple, today's Tuesday, yeah, maybe I can buy today. Maybe I could sell short today. I can participate in the stock today. But if earnings are coming up, I got to make sure that I'm out of that thing before earnings happen. Earnings are a crapshoot, a total crapshoot. If you trade earnings, sometimes you're going to get lucky. The worst thing that can happen to you is that you get lucky because the next time you're going to think you're going to get lucky again, and it ain't going to happen. So do not trade earnings. Another thing, very simple. Don't trade until after about 10:06 in the morning, 10:05 in the morning. And why are you coming up with such an obscure number? I have noticed in my career that when the market opens at 9:30, there is a lot of volatility. Where does that volatility come from? Well, it's all of the overnight trades settling. Some people put in their trades overnight, foreign exchange, everything is just bouncing around. And it takes about 30 to 35 minutes for the stock market to kind of settle down and get into place. So I don't want what's called a fake out to happen. I don't want, and this is a great example on Apple, I don't want the stock price to, for example, yesterday shoot up on me and all of a sudden 10 a.m. comes around and what happens to the stock price? It pulls right back down. Or this morning, it pulled back down and it's just bouncing around and it's moving. I don't want that. And during the first 30 to 35 minutes, it can be a crazy world out there. So what do? I just wait. I let the first 35, 36 minutes pass, and then I execute my trade. Another very simple one that you can pay attention to and not get burned on. Another very easy one, but very overlooked. And I've done a video on this in the past. It's called the bid-ask difference. So if you look up here in the corner, you have a red price right there, and you have a blue price right there, and you have the middle ground. The difference is 1 cent. That is absolutely ideal. We talked about this in the previous video. If there is any type of discrepancy between here, when you're playing in the market, it's exactly that. It's a market. It's a negotiation between two people when you buy a stock. There's a bid price, what somebody wants to pay, and there's an ask price. And the ask is what somebody wants you to pay them. And the difference between the two is the bid-ask spread. If there is a big difference, meaning, 10 to 15, it can go to $2 at some cases, 10 to 15 cents, you know that there's some manipulation going on in there. the ask or the market maker is trying to get a little bit more out of it. And what's going to happen? You're going to buy it up here, and then what's he going to do? He's going to drop the price right back down. So many people will say, Mo, every time I buy a stock, the stock price just pulls back on me instantly. I say, well, did you check the bid-ask spread? Was there a consensus between the two? If you want to check out the video that I did fully on bid-ask spread, go and check it out. But this is a very important one that you need to have at the top of your checklist. And still to this day, it's one of my top 3. Now, when it comes to moving forward, moving a car forward, what do you need? Well, you need gasoline. And what is the gasoline to the market? That's volume. You need volume to move forward. Something very big that a lot of people will miss is they will say, I bought a stock and all of a sudden, like this one, it just pulled right back down on me. Well, why did that happen? Probably because you weren't getting a lot of volume. There wasn't a lot of market participation. The general consensus behind volume needs to be there. So let's say that you buy a stock and you want it to go up, okay? You're going long on it. Well, what would be more beneficial to you? If you had a million other people out there buying that stock and pushing it in the same direction, or 10,000 people out there trying to push the stock price up. Think about it pushing a boulder up a hill. Would you rather have a million people pushing a boulder or 10,000 people pushing the boulder? You'd rather have a million because it's going to push it higher. It's consensus. It's everybody wants to push that singular boulder up that hill. It's going to work really, really well. And that's the idea behind volume. You want increasing volume. And when I say increasing volume, you want to see multiple days where the volume is higher than the next day, higher than the next day, higher than the next day. You can see here, there's these 2 days on Apple. What happened to the stock price? Well, it was above average volume. That's that yellow horizontal line, pushed up high. And then what happened the following day? Pushed up even more. That's what you're looking for. You want to see multiple days of consistent increasing volume. Or if you're selling, the exact opposite. Another key thing for risk management is knowing your resistance and support lines. Not only your major moving averages, which are incredibly important and just basically drawn in there for you. These are resistance and support levels just drawn in for you. They're going to tell you, if I'm running into a moving average, it's going to be very challenging for me to push up to the next moving average or just push beyond all of the moving averages. Just know that if you're buying going into a moving average, it's generally not going to work out for you just because it does have that level of resistance. Is it going to fail? No, it just might take a little bit more volume to push through it, but it's something that you need to pay attention to, saying, okay, I don't want to buy going into a 50-day moving average, a 100-day moving average, etc. Now also zoom the chart back. Zoom the chart back, and if those moving averages aren't there, just go and kind of draw your own. If I'm looking at Apple right here, I would have a very difficult time buying Apple up here at about $200 a share, $198 a share. Even if, let's say over the next 3 weeks, it gets up to that point. Why? Because it has proved about 3 times that it can't break through there. So if I'm a betting person, which I'm not, and some people say, well, you're gambling. Well, I'm gambling with a pretty good strategy, I guess, and I'm gambling based on patterns that I see. You're just running into a wall here that it has not been able to break since in mid-2023, couldn't break at the end of 2023, couldn't break in January of 2024. So I'm not going to bet that it can go through it again. If we pull up another stock, Bristol Myers, and we zoom all the way out here, zoom all the way back, and I'm just going to draw a line here around this level. And then if we can actually just move it more, let's see. Yep, so here, same kind of thing. This was back in 2016, couldn't break that same level. Is there one more? I think there was always one more. Nope, there's not one more. But you can see it couldn't break that level. And that's going back from 2016 through 2022. So zoom the chart back and see where those big resistance or support levels are, and don't get caught up buying right into them. So I know I'm throwing a lot at you. I just pulled up a chart and zoomed it out to 2016. And it's easy for me to say, it's easy for me to do. I've been doing this for such a long time. Let me be the mentor to you. Guys, I didn't learn this by myself. Nobody can do this by themselves. They can go on and they can find some videos and they can kind of pick pieces from here, pick pieces from there, and it can work for a short amount of time. The majority of people that trade do not make it this long. Why? Because they don't have any foundation. They don't have anybody to turn to. They don't have anybody to turn to ask questions on a daily basis. They don't have anybody to watch on a weekly basis and go, oh, wow, he just made a live trade doing this, explained it completely, made money on it. I wasn't in the trade, but I understood why he did it. There's a thought process behind it. And now he's going to go do it again. I can be that mentor for you. Let me be that mentor for you. Guys, I have a Patreon right now. It's $25 a month. There's less than 100 spots available. Like I said, I go live multiple times a week. You have complete access to me in the Patreon app where you can message me anytime. There's a lot of other great traders in there, some that have been around for multiple years. We have a few in there that are actually doing this full time now. It's a fantastic place to be. It's only $25 a month. Invest in yourself, invest in your future, invest in your family's future. It's really not that much. Think of it like you're taking a college class, but you're actually getting something out of it because you don't get anything from those college classes. Now, another thing, and this is where this kind of separates me from a lot of people. They don't pay attention to the trend. Or if they do pay attention to the trend, they exit it and don't trust the trend. You need to be buying when you have the highest probability to make money. The highest probability to make money I have found is in this area right here, in this yellow box that I'm drawing. That is what I call the sweet spot. The sweet spot is where you have the highest probability to make money. Give yourself the best chance to do it. If your stochastic is not here in the sweet spot, don't go after it. Right here, for example, you're all the way down here. This to me is not worth the short. The juice is not worth the squeeze. I don't even need to know a company it is, whatever. I want to be starting the trade up in this area up here. I want to be starting the trade up in this area right here. I want to give myself the highest probability to make money. Make sure the juice is worth the squeeze. Don't go and try to get the crumbs. Think about it this way. Here's another great analogy for you. You have a cookie jar, okay? Here's your cookie jar. And you have a bunch of crumbs down here at the bottom. And then you have your cookies here, and I'm the worst artist in the world, but ignore that. If you reach your hand in there, would you rather be grabbing whole cookies or these crumbs? Well, you want to be grabbing these whole cookies and pulling them out of here. That is when you're in the sweet spot. If you're grabbing crumbs down here, if you're the runt of the litter and you're going after them down here, you're grabbing this. You're just trying to pick up the pennies at the end. Some people will like to do that, but to me, that's not worth the squeeze. Now, another common thing that I see is people that will go after a stock price because the stock price is moving, not because they're paying attention to the candlestick or the price action that's actually happening during the day. So if we look at something like going back to Apple, and I keep bringing up Apple because the last 2 days, it's had these wicks on it. And this is a great example. People will buy Apple yesterday, basically, this green candle, because, let me get these whiskers out of here, because they saw that the stock price moved to this high of $176.03. And for me, I look at that and say, all right, there's a couple things going on here. Bid-ask spread, good. We're happy with it. We're going into a 50-day moving average, though. So if I'm going into a 50-day moving average or trying to eclipse a 50-day moving average, what do I want to have? Well, I want to have increasing volume for multiple days, not just one day. I would want to see these green volume bars kind of going like that and getting bigger and bigger every day. I bet you if they had this over the last 3, 4, 5 days, this stock price would have been up here by now because it would have the consensus. It would have all those people pushing that stone up that hill, but that's not the case. I saw volume, okay, going through the 50, expecting a pullback. So in this instance, I would come in at about 3:55 in the afternoon, and I would say, all right, what's going on? Is there a full engulfing candlestick? It's important to buy on engulfing candlesticks. This is another thing, a very simple thing that you can manage your risk with. Make sure you're buying on buy signals, and those are your engulfing candlesticks. Again, I've done a great video on engulfing candlesticks and the different types of candles that are out there and what they signify. But buying on a buy signal on an engulfing candlestick is so important and such an easy way to mitigate risk. Unnecessary risk, really. It's such a simple thing. It's what you need to do to become a really good trader on a consistent basis. So as we get deeper and deeper and understand this more and more, and you become a better trader and a more experienced trader, you'll start to see patterns. You need to make sure you're not buying into, for example, Apple right now. If this were lining up, and it kind of is, if you come over here, we're actually moving through the sweet spot pretty nicely. Take out earnings, pretend that we don't have earnings coming up. You're moving right into an ugly face. So an ugly face pattern, for those of you that don't understand this right now, don't worry, it's okay. That's not the idea of this. The idea is to show you as you gain more experience, there's going to be patterns that you're going to recognize and you're going to go, ooh, I shouldn't buy into that thing. That's an ugly face pattern. An ugly face pattern is happening right here. Usually that signifies this. We'll see what happens with earnings. But if the earnings were not there, then we would be looking out for this ugly face. And you don't want to buy in going into an ugly face pattern. Just like you don't want to buy going into a head and shoulders pattern, a tweezer pattern, etc. Don't worry if you don't understand these terminologies, you will get there. I promise you, just stick with it. But the idea is it's just another way that you, with a lot of experience, can save yourself a real headache and save yourself from some substantial losses if you don't have stops in place. So in this video, you heard me talk about that bid-ask spread and how important it is, something that I look at every single time. I made that video here solely on the bid-ask spread. Go and check it out.